I can see I've gone live, so hopefully everybody can hear me okay. Welcome to our update webinar in relation to the key tax issues that we believe the businesses in the Northeast should be considering in the new normal. For those of you who haven't met me before, whether that be virtually or in real life, I'm Alistair Wilson. I'm one of the tax partners here at Tait Walker. We've got about 45-minute long presentation today in terms of some of the key tax issues that we think the businesses should be aware of. And the last time we did a presentation to the Northeast was at the time of the budget in March. We said at the time we hoped we'd see everybody again soon. Well, we didn't think that that would be several months later virtually, but the purposes of this update is to bring you up to date in terms of some of the key issues. But what we're going to do to start off is just talk through the economic background. Now, if you haven't seen this slide before, this is actually, I suppose it's a recent slide from the Office of Budget Responsibility, which is an independent part of the government. And they've assessed the amount of level of debt that we have in the economy now as a result of dealing with the COVID pandemic. And on this graph, the bit that is of real interest is the very far right, the scenario period, and the line that shows that the levels of debt that the UK is now incurring take us to levels that are beyond what would have been seen in the last 60 years. We're into levels of what would be, I suppose, systemic debt for the UK economy at what would be post-war levels, something none of us have ever seen in terms of our working lives. And what that means for all of us is that the recession that we are currently going through in terms of trying to work our way out of that. Now, the Office of Budget Responsibility have said in the most optimistic scenario, we might end up with a V-shaped recovery where quickly we bounce back. In reality, what they are more likely saying is that in their central scenario, it will take a period of years for the economy to recover to where it was previously, prior to March. And what that means in turn is that the OBR are saying that we need, as a country, either to raise tax revenues or reduce spending to put our economy back on an even keel, public finances back on an even keel. So with all of that, we're going to go through some of the key things that we think businesses now need to start thinking about as we return to a new normal. But before we do that, what we are seeing as tax advisors is a change in role from HMRC. Now, HMRC's normal role is to collect all taxes due. Now, that means to make sure that people are getting them right and to collect them when they are due for payment. Over the last 3 or 4 months, HMRC's role has changed slightly in that they are handing out money. They are supporting businesses through the Coronavirus Job Retention Scheme, the Self-Employed Income Support Scheme, and from August, they're quite literally putting food in people's mouths by supporting the Eat Out to Help Out scheme. And I don't think anybody at HMRC would ever expect that they would find themselves in that position. They have also recently been supporting businesses through deferring VAT and deferring income tax instalments. And we'll come on to some of the things that you need to think about in relation to that. But what are we seeing now in terms of HMRC's approach? Well, if you asked us in April, we would say that HMRC were bending over backwards to help people. What we're seeing now is that HMRC are moving back more towards a business as usual approach. They're opening inquiries, reopening inquiries. Time to pay applications are definitely getting more robust in terms of what you need to give to HMRC. But at the same time, they are also helping in terms of some of the reliefs and share valuations, etc. And we'll come on to that. But time to pay, one thing that we think the businesses need to think about now is as the economy opens up, as they move into a recovery phase, and in particular when you end up in Q1 next year, whenever deferred VAT and deferred instalment payments may be due, time to pay, HMRC's message is that They are expecting people to approach time to pay with more rigor than they would have done in, say, April. And if people can pay their taxes now, the message is you should pay it if you can. And so businesses just need to be aware that they might need to pay tax when due, or if they can't, the application process is harder. So HMRC, it is, as far as they're concerned, business as usual in terms of filing deadlines, business as usual in terms of penalties, and if you can't make payments to HMRC, you need to have a dialogue with them. So overall, tax, we would see it as a key part of your business success in the next 6 months. For many businesses, there's been deferral of tax liabilities, understanding the cash flow required to make payments that have been automatically deferred or that you've elected to defer. There are support mechanisms that run through to October, and many of your businesses will have already been using those. But there are others that run on continually, like R&D reliefs, and we'll cover what we're seeing in terms of R&D reliefs. HMRC's tax reliefs do support fundraising. They do support helping you to recruit and retain staff. And so businesses should be looking at how to use those in the way that HMRC expect. But at the same time, you need to manage your tax risk, because HMRC are definitely back into the market whenever it comes to opening inquiries. And at the same time, you need to plan for future tax rises. There is an awful lot of debt now in the economy, and you need to plan for how HMRC and the government are going to recover some of the funding that has been provided to business as a whole. So we're going to cover a range of different taxes today. We've got a range of specialist speakers from our team here at Tait Walker, and we'll cover the range of different taxes, but at this point I'm going to start off by handing over to Andrew Fitton, who will cover off the corporation tax aspects.
Thanks so much, Alistair. There hasn't been any real legislative change in ongoing corporation tax, but there has been some changes in HMRC practice. And also based on what we saw in the financial downturn in 2008-9, we can anticipate, certain things. And I would at the outset encourage businesses to manage their corporation tax liabilities, and hopefully these will be pointers in terms of how businesses can think about managing corporation tax. So first of all, statutory deadlines. So good news, from an accounts perspective, statutory deadlines have been extended from 9 months to 12. So if you have a filing deadline falling anywhere between 27th of June 2020 and 5th of April 2021, then that filing deadline for statutory accounts with Companies House is now extended to 12 months. So if you have a 31 December 2019 year end, you don't now need to file till 31 December 2021. It's good news from an accounts front, and certainly I'd anticipate many businesses are talking to their auditors about post balance sheet events, what that means for going concern, and so on and so forth. It's a very difficult time. However, the corporation tax filing deadline has not changed, and that still remains 12 months after the end of the accounting period, which means if a company is running its filing deadline for accounts to the end of the year, it may find itself in a position where it needs to think about filing accounts and corporation tax computations on the same day, which is logistically quite difficult, and you can't file a corporation tax return without a set of statutory accounts. Furthermore, your payment deadline hasn't moved either, so that is still 9 months after the end of the accounting period. So if you don't have a set of statutory accounts or even draft statutory accounts on which you can base an estimate of tax, then making an estimate of what corporation tax is due could be quite difficult. So there are reasons there to think about, okay, when I'm thinking about when I'm going to file my accounts, when I'm actually going to file my tax computations, and how those two are going to interact. And I think the final point is a lot of companies may well have losses, maybe not in the accounting period ended 31 December 19, but it's a sort of a later accounting period, 31 March. And companies may want to think about when they actually sign accounts, because they may want to carry back losses, they may want to release corporation tax overpayments, and submitting a return is one of the easiest ways to do that. But again, you need statutory accounts to do that. So just think about the interaction between filing deadline for accounts and for tax purposes. Bit of a change in practice of HMRC in respect of carryback of losses. So companies can carry forward losses, can utilise losses by the companies in the group, but they can also carry back losses for a year. And this is something that companies took advantage of, certainly in the last downturn. HMRC has released guidance that enables companies to more easily carry back losses where those losses haven't been confirmed by the submission of return. So let's say, for example, you are anticipating losses for the accounting period ended 31 December 2020. Historically, going back a few years, HMRC would be reluctant to allow you to recognise those losses carried back to an earlier period until you'd submitted the 2020 return, which obviously could be too late. So HMRC is now more relaxed about companies putting forward provisional claims to carry back losses based on forecasts, based on estimates of what the current year is producing, to release repayments in prior years. But of course, you do need a reasonable amount of evidence. So year-to-date management accounts, forecast at the end of the accounting period, draft computations, and of course, the earlier you are in an accounting period, it is harder for HMRC to be comfortable that a loss will arise in the current accounting period to carry back. But that option is there now, and that's something that companies may want to consider to recover both QIPs and 9-month final corporation tax payments already made. One thing we noticed in the last downturn was a lot of companies made a lot of provisions against various things. And in terms of managing your corporation tax liabilities, you need to think about, when making a provision, whether that provision is going to be deductible or not. And in considering whether provision is deductible, there's 3 key points you need to bear in mind, and I'll go through those. First of all, the provision needs to be revenue and not capital in nature. So in tax, we make a distinction between revenue items, things that would normally go through your P&L, so bad debts, stock provisions, things like that, and capital items, which may be provisions against impairment of long-term assets and so on and so forth. The provision needs to be a revenue item to be deductible. Secondly, there needs to be no prohibiting tax rule. And there are certain provisions and certain reserves that you make which are not deductible when charging the accounts. They are deductible on a different basis. And a good example might be pension liabilities or payments of remuneration which are not deductible unless paid or will be paid within 9 months of the end of the accounting period. So you need to be satisfied that under what basis there's no prohibiting rule for that provision to be deductible in the current period. The final one is a key one. Insofar as the provision needs to be specific. And what I mean by that, it needs to be calculated with a reasonable degree of accuracy. There is a series of tax case law going back many years, which provides that general round sum provisions are not deductible for tax, and they must be calculated with accuracy. Accounting standards these days also require provisions to be calculated with accuracy. But please do consider that if you want a provision to be deductible, do some work on in detail on how accurate that provision is, as that will support its deduction. Another thing to think about is planning the use of losses and other tax attributes. So a position a group of companies wouldn't want to find itself in is if one company was profit making and paying tax, whilst there were unused tax attributes in other parts of the group. Now, I won't go through all the techniques. There's a list of techniques there that we as tax advisors use, which is not exhaustive, which we use to manage where profits and losses arise within a group. But to give you one good example, you may want to think about which company is claiming annual investment allowance, which is currently at £1 million, because that will obviously boost the losses in one company relative to the results of another for tax purposes. So it's really a case of thinking about how you sort of marshal resources, marshal your tax assets, whether it be losses, unused capital allowances, any other tax attributes that you might have, corporate interest restriction, debits, and the like, really to make sure that the whole group moving forward together, doesn't end up paying tax too early. Final point I want to make is around asset values. One thing we noticed in the last downturn, and it may well happen again in this downturn as we push on through, is that interest rate fluctuations, foreign exchange fluctuations in particular, and other changes in asset values can cause quite significant swings in fair values. Now, where you're fair valuing those items on the balance sheet, so it could be an item of foreign exchange, that can give rise to large taxable profits or large deductions, depending on what the item is. And so, it really is worth sort of looking down the balance sheet and sort of appreciating what may fluctuate in value and understanding whether that's going to have a tax impact or whether it's going to be a non-tax deductible item. And one thing I do want to draw particular attention to is debt releases. Debt releases between unconnected parties, so you and a bank, you and a third-party lender of some sort, those are taxable in the normal course of events on the company being released from the debt. That's not true. That's not the same in respect of companies that are connected. So if you're in a group relationship and you've got a lender and a borrower, effectively the debt release is ignored, and a bad debt provision is ignored. But in the context of a unconnected lender, that gives rise to taxable credits in the borrower. And that is something we saw an awful lot of last time, where banks forgave debt, but that really resulted in large taxable credits. Now, there are techniques you can employ to at least defer the effect of that, or even to eliminate it. But really, they need to be part of the initial conversation in regard to the release, and not something that can be done at the very last minute. So if you're talking about a debt release with an unconnected lender, please do talk to us early on in the process, because we can discuss if there's anything can be done to manage any taxable credits that would otherwise arise. Thank you. And I'll now pass over to our incentives leader, Holly Thompson, who'll talk to you about R&D and other incentives. Holly.
Thanks, Andrew. Morning, everybody. I'm Holly Thompson. I'm the head of the R&D team here at MHA Tait Walker, and I'm going to have a quick run through some of the tax reliefs you should be considering, and some of the cash generation methods you can be using during this time to sort of bolster your cash flow. So the first one is research and development tax relief and other similar incentives. R&D, which is kind of the main relief that we'd be looking at, is available to companies involved in innovative science and technology across a broad range of industries. So manufacturing, engineering, software development, things like that, where you're developing new products or processes and kind of improving the technology around those. The claims that you can make are currently being turned around by HMRC really quickly. So this time last year, we were seeing huge delays from HMRC. There was a spike of claims at the end of December and a spike of claims at the end of March, which led to massive resource struggles with HMRC, and we're seeing really big delays in repayments. Whereas this year, they seem to be on top of things quite well, and they're putting a lot of resource into making sure that they're getting turned around really quickly. So we're seeing funds generally being released within 6 weeks of the claim being submitted. As usual, small and medium enterprises are getting greater priority than large companies, but the large companies seem to be being turned around quickly as well. If you make an R&D claim and it creates a loss, you can use that loss either to carry back against earlier profits, or you can surrender that to HMRC for repayment of cash. If you're within the small and medium enterprise scheme, the SME scheme, that's a non-taxable cash repayment. If you are a large company, that repayment, it's a slightly lower benefit, but it's taxable and it goes above the line, so it is beneficial for reporting purposes. You have 2 years to make a claim for research and development tax credits. So at the moment, until the end of the month, any account period ending from July 2018 onwards is still within scope to make a claim. But there is one hurdle that you might need to think about given the current climate, and that is if the company is having issues with its going concern status, then it may not be able to make a claim because it has to be a going concern to get the benefit of that cash back from HMRC. However, if your last set of accounts were prepared on a going concern basis, there shouldn't be anything stopping you from going back and making a claim for that year. So it's definitely worth considering if you haven't made a claim before, having a look at it. Similarly, if you have been making claims, potentially try and accelerate those claims to get that cash in a bit sooner than you normally would. There's other similar tax reliefs available as well. So a patent box, if it's a company which owns patents, then it may be worth considering whether any relief's available for that. And museums, galleries, theatres, film production companies, television production companies, and video games companies, there's a whole host of tax reliefs not dissimilar to the R&D scheme, available for those companies as well, which trigger cash repayments. Another thing to consider is capital allowances. So as Andrew mentioned earlier, there's £1 million annual investment allowance available, and if you haven't been using that but you've purchased property or you've built property from scratch, it's worth considering whether there's anything in there that qualifies for annual investment allowance, because buildings don't usually qualify for those reliefs. They usually get relief over a longer period of time, if at all, for those. So it's worth going back and looking at any purchases of property or building a property from scratch and seeing whether you can get any additional relief for the plant and machinery within those buildings. Similarly, any purchases of any energy efficient plant and machinery prior to 1st of April 2020 can potentially put you in a position where you might be able to get some cash back. If it creates a loss, you can potentially surrender that loss. Now, that was phased out from the 1st of April 2020, but purchases before that date are potentially still eligible. And similarly with the R&D, you've got 2 years to make a claim. So at the moment, July 2018 year ends onwards are still within scope for a potential claim. There's also the new structures and buildings allowance, which if you haven't made use of that, it might be worth considering whether you can go back and amend any of your previous computations and free up some cash that way. The final thing to consider is debt finance. From a business point of view, companies might be struggling with cash flow. They might be having, issues with invoice finance, that sort of thing. There might be different options for getting cash released into the business. Most SMEs tend to approach only their own bank for funding, and they don't tend to give a lot of time before they need the cash, so they don't spend a lot of time researching it, but there's actually hundreds of lenders serving the SME market. The major banks at the moment as well might be more cautious than they usually would be, so we'd recommend having a look at the whole market to see what's actually suitable for your business. And our corporate finance team has some resources available on our website, and we also partner with a firm called Capitalize, where we can carry out searches on your behalf and kind of help point you in the right direction of things. So if there is any funding that you think you need, it's worth considering what other options are out there other than just your normal bank. So we would recommend getting in touch if you've got any questions on that. And with that, I shall hand over to Adeem Sultan, our head of VAT. Adeem.
Thanks, Holly. Hi, I'm Adeem Sultan. So I lead the VAT practice here at MHA Tait. So I'm just going to run through some of the key VAT changes we've seen since the spring budget. It'll come as no surprise that most of these have been driven by COVID-19 and the government's response to that. Like most countries, the government here have used VAT as a key lever for addressing some of those issues caused by COVID-19. So the first thing we're going to cover off is the VAT payment deferral. So hopefully everyone's heard of the VAT payment deferral. This is whereby any VAT payments that were due between the 20th of March 2020 and the end of June could be automatically deferred by any VAT registered business. We were hoping that this was going to be extended beyond kind of the end of June. The government's taken a more targeted approach rather than kind of providing a universal support. So at the moment, there was no planned extension to the deferral. The key point we wanted to make business aware of is that obviously as a deferral, businesses need to manage their kind of cash flow because this money will need to be repaid before the end of March 2021. So you need to obviously have that in mind in terms of forecasting your cash flow. Another kind of welcome change from the COVID-19 crisis is a deferral to the MTD kind of soft landing period. So this soft landing period was kind of put in place to allow businesses time to kind of update their IT systems to have digital links. One of the key points around MTD is to remove manual intervention. So this has now been extended to the 1st of April 2021, which is a positive step. Anybody that's in the construction sector would have been aware that there was to be a new domestic reverse charge for construction services. This was due to come in on the 1st of October this year. Given the impact of COVID-19, the government has delayed this for 5 months. So the domestic reverse charge for construction services will now not come in until the 1st of March 2021. One of the key, obviously, impacts around COVID-19 has been around PPE, and there's been a number of changes around kind of PPE. So in terms of PPE, there is a new zero rating for PPE. There's also been a acceleration of the zero rating for e-publications. So this was the so-called reading tax. So from the 1st of May, kind of e-publications are now subject to a zero rate. So if you get an online newspaper, that's now treated in the same way as if you bought a physical newspaper. The zero rating for e-publications has been very welcomed by the industry, and it was due to come in on the 1st of December. So there is an additional kind of acceleration there. It doesn't cover electronic publications that are predominantly for advertising or have a large amount of audiovisual content. Anybody that's importing PPE, there's also a kind of a relief for businesses importing PPE if they're bringing things in for the likes of the NHS or charitable organisations. If you're involved in that kind of sector, please do speak to us. A very recent change is the kind of reduced rate for the hospitality sector. Again, this is a sector that's been very badly hit by COVID-19. So there is a new 5% rate of VAT for certain elements of the hospitality sector. If you supply food, alcoholic drinks on premises, so this is your restaurants, your pubs, cafe, you can now charge 5% rather than 20%. Obviously, beer sales are still subject to VAT at the standard rate. This also applies to hot takeaway food. It applies to hot takeaway drinks. It's a little bit of a nuance in the legislation. If you went to Starbucks, you could get your coffee reduced rated, but if you bought a can of Coke, that would still be standard rated. The reduced rate also applies to hotels and hotel accommodation. It also covers things like campsites to encourage obviously people to go on holiday. The new reduced rate also applies to admission to attractions. So this is purely for admission. So there is a list produced by the government which is shows, theatres, circuses, fairs, museums, amusement parks, concerts. The list, or obviously we're advised by HMRC, isn't an exhaustive list. So there are other kind of similar businesses that will be will qualify for reduced rating. So things like stately homes has been confirmed. They'll also be covered by this, although they're not expressly mentioned in the legislation. And one of the big impacts that people have probably noticed about COVID-19 is that we don't hear about Brexit as much as we used to. Unfortunately, Brexit hasn't gone away. And as of yet, we do not have a deal with the European Union. The transition period is due to end at the end of December. So from the 1st of January, as we currently stand, we're looking at what was previously called a hard Brexit scenario. Again, this is a point of this just to highlight that businesses need to start preparing for Brexit and kind of that hard Brexit. The government's own kind of research has found that only 25% of businesses are actually ready for Brexit. You'll have seen their new campaign. So they've launched a new campaign, which is check, change, go. So obviously, again, businesses need to check what their changes are and how those changes impact them, amend their systems, and obviously go. In the last week, the government have released a paper which kind of sets out what they view the new customs arrangements will be kind of in a post-Brexit scenario. There's 200 odd pages of kind of text there, lots of questions, not as many answers as we'd hoped. One of the things, obviously, with a hard Brexit scenario is that there will be customs duties, and the government released on the 19th of May kind of a new global UK kind of tariff, which sets out what the tariffs will be. We'll also have tariffs going the other way. So if you're an exporter, you need obviously be prepared for tariffs. Brexit's obviously quite a big change. The government have set aside some money for kind of funding training. So if you're a business that's newly kind of being involved in imports and exports, you can get some funding for training. So within our MHA network, we do provide training for businesses on the new changes in terms of customs duty. If you've got a new member of staff doing that, there's also government funding available for IT changes that have been caused by having to now deal with imports and exports. And if you're recruiting as well, if you need to recruit a customs specialist, there's also funding to assist with recruitment. So it's worth having a look at the government funding there. And if you're interested in specific training, we can obviously assist with that. Final point is around cash flow. So cash is king. again, businesses still aren't doing some of the basic things to kind of either delay when VAT is due or to kind of ensure they're paying the right rate of VAT. One of the things is if you're a business that does a continuous supply of services, you don't have to account for VAT until you've received payment or you've issued an invoice. So businesses can delay the tax point by doing requests for payment. Many businesses just out of kind of habit just send invoices out. So it's just having a look at your VAT position to make sure that kind of you're optimizing the kind of the cash flow from a VAT perspective. And I'll hand over to my employment tax colleague, Claire Williams. Thank you.
Thanks, Adeem. For those of you that don't know me, I lead up the employment tax team at MHA Tait Walker. I'm just going to do a quick whistle-stop tour of the things that we've been seeing in employment taxes over the last few months. The first thing that obviously I need to mention, it's been the biggest part of my life recently, is the coronavirus job retention scheme. Most of you, I'm sure, will be using this, and if you're not using it, then that's a very good sign. But for most people, you will have already been using this. So I'm not going to go into the background detail. I'm just going to say that it continues until the 31st of October 2020, although there are changes coming. So on that table there, I've set out what the changes are going to be. So from March till July, you could claim 80% of a furloughed employee's wage up to £2,500 cap, plus the employer national insurance on that furlough wage, plus qualifying earnings pension contributions. In August, this will change such that you can't claim the national insurance or the pension. And then in September, the wage claim will go down to 70%, and then it'll go down to 60% in October. One of the changes that has been brought in is that in July, you can now start to use flexible furlough. So effectively, you can bring back staff that you've had fully furloughed so that they can work part-time. You pay them for the hours they've worked, and the government pay them for the hours that they're furloughed effectively. One thing that has been confirmed recently is that if you have been making a claim under the CGRS scheme, you still need to pay the PAYE tax and national insurance that would have been due for the employees that have been furloughed on the normal payment date. So if you've literally been receiving the money and not making any tax or NIC payments because you've got, for example, a time to pay arrangement in place, you need to consider what you should have paid over because there will be interest due. It was announced just a couple of weeks ago that where employers retain furloughed staff continuously from October until, well, beginning of November until the end of January, those employers will be entitled to a £1,000 government bonus. That bonus will be paid in February 2021 after the RTI submissions for January have been made, but there is eligibility criteria, which includes that each of the employees must be paid at least £520 per month between November and January. They must work for you continuously in that period, and they must have previously been included within your CGRS claims. Any claims for periods up to and including the 30th of June must have been submitted by 31st of July. Most people that kind of file claims on a calendar month basis will already have this in hand, but just bear in mind if, say, you have a pay period, a monthly pay period that runs from the 21st of June until the 20th of July, the last 10 days of June, you need to make sure the claim for those 10 days is submitted as soon as possible so that you don't miss out on the relief that you can get for those 10 days. Throughout the whole of the CGRS claim, you must pay your furloughed employee at least 80% of their usual wage up to the £2,500 cap, regardless of what you can claim back from the government. Unfortunately, redundancies are going to be inevitable. It's something that we've had quite a lot of questions about from employers. Unfortunately, it's just the way it is in the current circumstances. HMRC have confirmed, however, that where you have had an employee furloughed and you've been claiming CGRS in respect of that employee's wages, then for the period that the employee would have been working their notice, but they are on furlough, you can continue to include them within your CGRS claim. So that's worth bearing in mind if you are about to give employees notice that you can continue to claim for those employees. In many cases, you'd be better allowing the employee to work their notice whilst furloughed rather than paying them a payment in lieu of notice, because for a payment in lieu of notice, you cannot include that within your CJRS claims. Another thing to bear in mind on redundancy is that taxation of redundancy changed. It was back in April 2018, but hopefully you haven't had to make redundancies in the intervening period. Basically, it changed to mean that it's much more restrictive in terms of how you can pay redundancy payments without having taxation consequences. Wherever there's a payment in lieu of notice included within somebody's redundancy package, that is now taxable. So that's regardless of whether that was contractual or not. So people used to talk about the £30,000 tax-free amount. It's rare that many people get to use that now, so it is worth having that, giving that some thought. Moving on to share schemes. Share schemes have been for a long time a very attractive way of incentivising employees, because you can link the value of the business to the rewards that the employee gets. It motivates the employee to help you grow your business. In the current market, and with the fact that many businesses are having hits to their financial position, we've been really successful agreeing lower share scheme valuations with HMRC, which means that you can get the shares into the hands of the employees in a much more tax efficient way, and in a way where they don't have to pay as much for the shares in the long run. EMI schemes are still the most attractive type of share scheme, so if you can use them, it's worth thinking about them if you have key members of staff that you want to incentivise. It means that you don't have to pay out big bonuses now and take that hit now, and you can really get them investing in the future of your business. There are other share schemes as well that are really effective way of rewarding staff. And I guess one other point to make about EMI schemes, if you have been in a position where you've had over 250 employees and you have had to make redundancies, for example, you may now be in a position where an EMI scheme has become an option for you. And the final thing that I want to touch on is electric vehicles. The table that I've put on this slide shows that the benefit in kind rate for electric vehicles has reduced substantially, such that for the most efficient vehicles, there's no benefit in kind charge for them. The most efficient vehicles also benefit from corporation tax reliefs in the form of enhanced capital allowances or deductible lease payments. So it's something that a lot of businesses are looking at and considering for their employees where they have a company car fleet. In fact, over the last 3 months between April and June, the Tesla Model 3 has been within the UK top 10 best-selling cars for every month, topping the charts in both April and May. So it's something that a lot of businesses are looking at, and it's worth considering if you have a company car fleet, not necessarily a Tesla, but you could go for a cheaper version. And on that note, I will hand over to my colleague Chris, who will talk you through personal tax.
Thank you very much, Claire. So this morning I'm going to be talking about tax matters relating to individuals, sole trader businesses and partnerships. So the first matter I'm looking at is the 31st of July payment on account for self-assessment. Question is to pay or not to pay. So that payment on account, the due date has now been shifted back by 6 months to the 31st of January 2021. This date is shown on the statements of account that have been issued to taxpayers, but the accounts do actually also include a remittance advice to allow payment to be made to HMRC now if you want to. Obviously the deferral is just that, so the tax is still payable 6 months from now. On the same date, you're also going to have to pay any balancing payment for 1920 and also the first payment account for 2021 on that same date. So what are clients doing? Well, some are deciding not to make the payments and to defer the tax. So the reasons could include the sector in which they operate, means they've had no income at all since lockdown. They might have use for the money for the next 6 months, which expect to produce a very good return. For some, it's just a feeling that it's better to have the money in their hands. If the pandemic's taught us anything, it's to expect the unexpected, and this gives them a contingency. So what we're saying to all of our clients who are not making the payment is the tax is payable in January 2021, and there's going to be no further deferral of that tax. Ideally, keep the money in a separate account, so the funds are only used for specific purposes and with a plan as to how they're going to be replenished by the 31st of January 2021 to allow the payment to be made. Now, some are choosing to make the payment. Reasons for that include it's what they're used to and they want to know the tax has been paid. They worry that if the tax isn't paid, they could forget about the deferral and then struggle to make the large payment in January 2021. For some, they're involved in a partnership, and that partnership provides the funds to pay the tax. And the partners want to know that the tax has been paid and they are not left with an unexpected tax bill in January 2021 for which they are personally liable. But the money for the tax has been spent by the partnership in the meantime. So the next point is about trading losses, because sadly a number of unincorporated businesses will make losses in 2021 because of the pandemic. Now the relief can be claimed to either offset that loss against other income of that year or to carry it back to 1920 tax year. So coming back to that large tax payment on the 31st of January 2021, if the July payment has been deferred, such loss relief allows us to reduce the payments on account for 2021 when submitting the 2020 tax returns. We can only claim a loss for a carryback to 2019-20 though after that tax year in 2021 has ended. So the other option we have is that with a unincorporated business, you have different year ends. So where a business has a year end other than the 31st of March or the 5th of April and a loss in 2020-21, we might consider changing the year end. So we have a year end of 30th of April 2020. So for the tax year 2021, you're only including a small part of the lockdown period, and the rest of any loss as the lockdown played out is going to be coming to the tax year 21-22. Now, changing the accounting year end could bring all that lockdown period into the previous tax year, into the 2021 year, and then bring forward the relief on those losses. The other point on the change of accounting date is it can also trigger the release of part of any overlap profit being carried forward year by year, and so increase the loss further and therefore reduce the tax. So self-employed income support scheme is the other point I'm looking at, the CEASE. So the first round of payments to self-employed persons was made in May 2020, although only about a third of our clients with self-employed income qualified. There is a second round of payments with applications starting on the 17th of August 2020. That payment will be 70% of the average profit for a 3-month period. Therefore, the payment on the second round should be about 7/8 of the first payment of CEASE, which the people may have received. So for CEASE, there are various conditions. The person must have submitted a 2019 tax return, including self-employed income. The trade must be affected by coronavirus. It must still be ongoing and will continue. And then there are conditions about average profit and that your self-employed income must be more than half of your total income as well. So in terms of the idea of affected by the coronavirus is my final point. So to qualify for the second round of payment, the effect on the trade must be applying to you on or after the 14th of July 2020. So if you're self-employed and your business is now trading at pre-lockdown levels, you can't qualify for the second round, as the claim requires you to state that your business has been so affected. HMRC have issued some guidance on what affected by the coronavirus means. Could include where you're not trading at all, or just a fall in the level of trade. The effect might be that your income is less than it was, perhaps because of the effect of social distancing, even if you can now trade. It can also be that your expenses are higher, say if you have to take on extra staff to deal with customers, or have to incur costs to make your premises COVID secure, and that might include buying PPE. So quite a wide-ranging definition of affected, but just be aware of that point. So now, that's my part finished. I'll pass you on to my colleague, Claire Smales. Thank you.
Thanks, Chris. Morning, everyone. So throughout this presentation, we've heard about quite a lot of the measures that the government have put in place to help individuals and businesses in the last few months. But one of the next questions is, how's all this going to be paid for? And what we would expect is that there's going to be some changes in tax policies, and the government may seek to use it as an opportunity to review some of the current areas of tax where they see a perceived mismatch. So the first thing I'm just going to mention is off-payroll working rules. So this reform, it was due to be implemented in April 2020 for the private sector and to sort of mirror the rules that are already in place for the public sector. Now, thankfully, this was pushed back to April 2021 on the basis that the government recognised businesses had enough to deal with at the moment, given the current circumstances. What this is intended to do, it's to address the perceived mismatch that workers in will pay the same tax and national insurance contributions as an equivalent employee within the business, and it puts the responsibility for setting this tax status onto the business itself. So as I say, this was pushed back to April 2021, but it was announced that it's very much a deferral and wasn't a cancellation of this policy. And this was further emphasised when recently a proposed amendment to push it back another couple of years was defeated. So the message really is with this is that you should continue to plan for the introduction of these rules. There will obviously be an increase in administrative burden for businesses, but there could also be some cost increases. So similar to this with self-employment tax policy, when the government were devising the support packages available for individuals, it was a lot more straightforward, I feel, for them to introduce it for employees versus self-employed. And the Chancellor did indicate that the future tax policy may need to change to reflect the fact that they've been given an equivalent relief. The main area where we see this difference is around national insurance contributions. And you'll see just there I've laid out the key differences. There's an obvious gap there. The government did try to introduce some changes a few years ago unsuccessfully to increase the national insurance contributions paid by self-employed individuals. But what I would expect, it may be something that try to address again, and they may be more successful given the current circumstances. And finally, last week it was announced that the Chancellor had asked the Office of Tax Simplification to undertake a review of the capital gains tax regime. The scoping document of this, it was very, very wide, and it was looking at everything from rates and reliefs all the way through to how it interacts with other parts of the taxation system. As I say, that this was just the initial review was announced last week, so it's very, very early days with this, and we don't know yet what this is exactly going to mean. But what we'd expect, it may be looking at increasing some of the capital gains tax rates. They're a lot lower than the income tax rates, and they may look to bring them closer in line. Also looking at some of the reliefs and allowances, are they able to reduce some of those as well there? So some of the things that you may want to have a look at is if you're looking to dispose of an asset or making a disposal that's going to trigger some sort of capital gains tax liability, would it be beneficial to try and accelerate that and do that sooner rather than later, just while we have some certainty over the tax treatment? Also, if you've been involved in a transaction quite recently where you may have received some form of consideration which didn't trigger an immediate tax charge. So an example may be if you've received some loan notes where you may not necessarily have paid tax at the time of the disposal, but instead you would be taxed on them at the point they're actually redeemed. Would it be worth looking at bringing forward that tax charge again when there's some certainty over what that is? Disadvantage being it would mean it's triggering an actual cash liability that you would need to pay over, but it's definitely something worth considering. So with that, I'm going to hand back to Alistair just for closing comments.
Just before I very quickly summarise, if you haven't spotted it, there is a question facility on the control bar that will be on your screen. So if there is anybody who's got any questions, feel free to put them forward. We will also be giving details of all of the speakers today, and so if there are any questions you would like to ask directly, then clearly we would be very happy to answer any questions one-to-one. Obviously nowadays everybody is used to working virtually, so it is something that's now very easy to do if somebody wants a quick call on something like Teams or Zoom. Just before, or just whilst I give the system a chance just to see if there's any questions. In terms of summarising, hopefully you've seen that there's been a lot of activity in the tax policies, the tax system over the last few months. An awful lot of it has been very helpful to business. What we are seeing from HMRC is that they are being very quick in terms of adapting to implementing systems that help businesses, but at the same time we are expecting that they will take a very strict approach with any businesses that are seen to be taking advantage of the systems. Likewise, we expect that the Chancellor will see this as a really easy time to fix some of the inequalities in the system whenever it comes to taxation. So where there are areas that the Chancellor has been too scared in the past to try and raise taxes, now is the time that it's very easy to do it, because the public know that everything that has been given out over the last few months has to be paid for in some form or other. So hopefully you've found that a useful roundup in terms of the key things that we have seen over the last few months. I haven't seen any questions come in, so I would say if there are any questions that you would like to raise, then please do feel free to direct them to the speakers who you've heard from today. Hopefully, by the time we have another roundup of this sort of nature, which is likely to be at the time of the budget in October, we'll be in a position that we can stand up in a room to present to some of you, maybe not, but fingers crossed. But with that, unless anybody has got any questions that you'd like to direct to the speakers today, then I would say I'll bid you enjoyable rest of your day, and thank you very much to all of our speakers for presenting today, and obviously we'll send copies of the slides out to the attendees. Thank you very much.